Good afternoon, everyone. Happy Webinar Wednesday. This is the kickoff to the Wells series of online webinars. Excited to be with you. I'm actually tuning in from Asia, so it's a little later here. But hello, everyone in the States and wherever you're tuning in. Thank you so much for being part of our community, being part of the Well, or among our friends and partners. So we're going to provide an overview for 2025 for the food and beverage industry, and in particular, highlight top 5 trends. So I'm Mark Nguyen, the managing partner of The Well. Um, Very excited to be here with my colleague Brian Choi with The Well and the Food Institute. And Brian, if you want to say hello.
Yeah, hello everyone, and great to be part of this is the inaugural webinar for the Well. So appreciate you guys your patience as we're working out some of the technical details. But yeah, just thrilled to be part of this community, and we'll share more details about what the Well is and how you all can be more involved. I'm managing partner and CEO of the Food Institute. I'm one of the founding members of the Well, alongside with Mark. And yeah, today's presentation will just share a few thoughts on what we're expecting in 2025. But would love to hear your comments as well. So this is meant to be interactive, and we want to hear your thoughts, and hopefully we can get the chat function to work at some point. To get your comments and questions. But that's a little bit about me. And Mark, maybe you can share a little bit about your background as well.
Sure. Yeah. Thanks, Brian. It's it's really interesting when your worlds connect, and I feel like that's the case today as we start our webinar series. So my first career has been in international trade, uh, kind of going back to what I studied in graduate school and focused on, which was international trade policy, law, and regulation. Um, I started that career actually in the 1990s uh, when the World Trade Organization was launched after 1995, working in Geneva, Switzerland with the WTO and then with clients globally for over 10 years. And so I've monitored international trade trends, globalization, and issues like tariffs for quite a while. And I still teach that topic at a couple universities. And that's actually why I'm in Vietnam at the moment, teaching on international trade and business. So that's sort of uh, part of my background that is now connecting to this world of food, beverage, consumer tech, and wellness, um, which is certainly um, going to be impacted if there are tariffs across the board that may be implemented as soon as next month. And so those are some of the trends that we'll be looking at. Um, so it's um, again, it's an honor to be a part of the Well, and to be among this community that's joined here and has joined throughout this year since we launched at the Expo West Natural Products Conference in Anaheim in March. And since then, we've had about 16 events in Southern California, New York City, which is where the Well Network is based, as well as Washington, D.C. and Denver. So this kicks off our online programming. So thanks everyone for joining.
All right. So I guess we can get started, Mark. You want to kick off the first of the 5 trends here?
Sure, let's get started. So the first of the trends, before we kind of dive into things, let's take a look at the global economic outlook. Um, a number of international organizations, including the International Monetary Fund, the IMF, and the OECD, have started putting out their uh, outlook for next year, looking at global growth in the United States as well as globally. And these organizations predict that global GDP growth will be steady at about 2.5 to 3% around the world, with the world economy being fairly resilient. U.S. growth is also steady at about 2 to 2.5, although the IMF predicts the U.S. growth may be going down slightly or even possibly more, depending on some of the unpredictable policies that might happen anytime you have a new executive presidential administration that comes into office. So some of the trade winds that the international organizations as well as um, private analysts have predicted could come from the trade wars, which we'll take a look at more closely uh, as a result of tariffs that the US and others may impose. Um, on a positive note, inflation is declining globally, looking at 3.8%, which is a really nice target number, and the US slowing even further to about 2.5%. Though with tariffs, these are additional costs on imported goods. That number actually could go higher. And interest rate cuts are expected to continue, including in the US, which is at 4.5% now, and that's looking to probably go into 3.2 or 3.5. So looking at the broader sort of global economic outlook, let's take a deeper dive into what's going on with the US. So on the US front, um, there's a lot of concern that tariffs could be implemented very quickly. Uh, President Trump has done this before, and he's used his executive powers using executive orders, which could impose tariffs across the board. It's not necessarily legal under international trade rules like the World Trade Organization, WTO rules, or under the US, Mexico, Canada, and other free trade agreements. Um, but it could direct US Customs to impose across the board 10 to 20% tariffs for all trading partners. So the difference this time around is that it could impact not just imports from China or some key trading partners, but all trading partners. And the US imports about 2.7 trillion in imports. Um, so if tariffs hit across the board, whether China, Canada, Mexico, Europe, and so on, that certainly could impact virtually any industry that imports any type of ingredient, finished good, inputs, um, or product from any other country. Um, President-elect Trump has also made statements, including on social media, saying that starting day one, he's looking to impose 25% tariffs on our top two trading partners, Canada and Mexico. In fact, Mexico is now the U.S. Is number one importing partner. Um, it's surpassed China. And the reason why he's looking to do that is he's saying that is would put pressure on Canada and Mexico to address immigration and the flow of illegal drugs into the US. Um, with China, President-elect Trump is proposing to impose even higher tariffs beyond 25%, up to 60%, potentially across the board, which would be crippling for trade with China. Um, so what happens if this is the case? Trading partners could retaliate against the US. China did so the last time around, citing violations um, of obligations that the US has made For example, in the WTO, there are countries, 164 countries, trade on the basis of Article 1, most favored nation status. So to impose tariffs across the board, that it would invite retaliation by many of our trading partners. And tariffs are not paid by our trading partners, they're paid by importer, the importer of record, which is could be the retailer, it could be other importers. Whoever's bringing in the goods would pay the tariff to U.S. Customs. Companies, as a result of paying those tariffs, if you're, say, a Walmart is the importer record or whoever that is, could pass on the goods. If you're a if you're a major food company bringing in finished goods um, from Canada even or fresh fruits and vegetables from Mexico, you may pass on that 25% increase that you've had to pay. Tariffs are usually paid ad valorem, meaning it's paid by the value of the good, or it's a specific duty that's set for a particular good. So oftentimes, importers will pass on those costs to consumers or to downstream industries. If you're a steel company, you may pass that on to the automotive and other appliance manufacturers that um, um, do that. In the food and beverage world, if you're bringing in, a particular ingredient, you may be passing that on to the downstream producers. Um, there are estimates that these potential tariffs could hit hardest the low and middle income families, about 3,000 per household, which is based on some of the initial estimates. And once imposed, tariffs stifle competition. They invite retaliation by trading partners and could destabilize the global trading system, which since 1947 has been in has put in place rules that uh, create for more predictability. So the tariffs are certainly would destabilize that if it's imposed unilaterally. Goldman Sachs, in a um, report last month, in their last forecast, said the biggest risk to growth is large scale across the board tariffs, which would hit US GDP growth very hard. Um,
Hey,
so,
Mark, maybe just a quick question for you.
sure.
As it relates to these tariffs, how much of it is rhetoric versus reality? So is it more like, is it likely that Trump will in fact do a across the board type of tariff? Or is this just like a negotiating tactic um, to secure some other type of deal with these countries? Anything that you can share about that?
It seems like most of his statements indicate that starting January, that especially maybe for some trading partners like China, he may act quickly. It could be negotiating, but it could also be, let's start with China, which, many uh, people might say, oh, that could be the problem country because China is not respecting intellectual property. They're flooding US with goods below market value, which is there are other remedies to that, for example, anti-dumping and safeguard measures, but tariffs are an instrument that can be used to remedy some of these issues like trade deficits and so on. So my prediction is there will be some across the board tariffs, maybe for some select countries, um, or there could be some minimum level of tariffs across the board. Um, and then a lot of companies will scramble to gain exemptions. So that'll be the next um, um, part of the outlook is how do what are the solutions to this? You're suddenly facing costs that could be rising dramatically very quickly. So I think there will be a number of tariffs. They have been imposed in the first Trump administration, especially towards China. So China could again be the target.
Got it. And then, what are your thoughts in terms of what sectors within food and beverage will be most hit? Um, any comment on that?
Yeah, there when you have across the board tariffs, it hits virtually everything right away because most U.S. tariffs are actually quite low. The U.S. and most developed countries have negotiated over the course of 50 years in the WTO GATT system, lowering most of their tariff bindings to actually fairly low levels outside of some sensitive industries. So for the food and beverage industry, unfortunately, it could hit most sectors um, right away.
So basically, like, is it fair to say that any food and beverage company that sources their products domestically, they're obviously not going to be impacted, right? Is that a fair
Yeah,
assessment? So any sort of import, whether it's a raw ingredient, whether it's some form of technology, those companies, depending on the degree of which they import the raw materials or inputs, they're going to be most affected. Is that a fair and general assessment that you would agree with?
yeah. So tariffs hit tangible goods that
Right.
are imported through the harmonized tariff system of the US. So these are goods that cross borders. So tariffs don't impact services so they have to be a
Right.
tangible ingredient, finished product, or component of something. Um, but they can also include packaging. If
Right.
beverage companies are importing um, packaging or aluminum or or whatever cans or whatever it may be, that could be impacted. But yes, anything produced within the borders of the United States um, is um, not subject to tariffs. So certainly that's part of the objective is to bring more production back to the US and to generate more jobs. But whether or not more jobs will be generated versus more jobs may be lost due to high cost is another factor.
Okay, great. Thank you.
Sure. So to continue on um, sort of responses and solutions. How do companies prepare for this? What can they do? Um, Companies, I've heard, I'm in Asia, I've been in Asia the last couple weeks. I've heard a lot of companies trying to expedite their imports from China and Asia and other trading partners as quickly as possible before the end of January. But again, that's a short-term solution. Consider alternate sourcing. So yes, like Brian mentioned, sourcing from the US is the only really safe haven where you're not going to be impacted by tariffs. Potentially other markets, maybe the EU and Europe might be hit by lower tariffs than China. Uh, if I were a lot of companies, I would be most concerned with China. China is probably going to be hit the hardest and the quickest. And other countries will probably face tariffs too, but not 60%. Maybe 10 to 25 is more likely. Um, what happened the last time is major companies that were importing from China requested exemptions from the administration for certain categories, and they made a case or appeal uh, so a number of these exemptions were granted, but not necessarily immediately. What happens is there will be a flood of requests, uh, incredible amounts of lobbying. I lived and worked in Washington, D.C. for over a decade, and I would say lobbying will return full force and very, very quickly because many companies will try to hire lobbyists to seek exemptions for their industries because these are real costs that they'll face. So if they're going to hire expensive lobbyists, that's nothing compared to the high costs that they may be paying as to continue to bring in goods. Um, so many companies will request exemptions from the administration. They'll lobby Congress, their representatives, to try to gain these exemptions, or broader, to try to persuade the administration to change course, limit the extension of the tariffs, exempt countries, exempt industries um, from the impact. And some companies will also work with the trading partners to make the economic case that, it's U.S. jobs are created by bringing in these ingredients, and that could really impact U.S. jobs. Um, because the flip side is this not only impacts imported goods, but China and other countries, and Mexico's president, she's already made the statement that if the US is going to impose 25% tariffs across the board, Mexico will retaliate. And Mexico is one of the largest uh, exporters and importers of US goods. So if Mexico retaliates against US uh, exports to Mexico, that could certainly raise cost and limit growth for US exporters too. So it's a trade war. So it's not only a US uh, uh, tariff situation, it could be a global trade war with countries retaliating against the US for what, the US is doing, which is raising costs to their exports. They'll raise costs to imports from the US. So this could lead to disputes and retaliation and at the end of the day, a lot of disruption to the global supply chain. So at the end of the day, what happens? Companies will import less products or ingredients or import inputs or, you know, packaging or whatever it may be. They may have to absorb some of these costs, which will, certainly reduce their own profits or their ability to grow, and they'll have to probably raise prices. So these are mo most likely the responses. So yeah, I don't know, Brian, if you have questions on that.
No, no, I think it makes a lot of sense. We'll definitely get more clarity in January, but I think the responses and solutions kind of um make a lot of sense. So I think for CPG companies that where either you're sourcing product in the US or other countries, definitely, now would be a really great time to look at some alternative input sources. It's all about risk management at this point, and until we get a little bit more clarity from the Trump administration in January.
You know, and even though the US is the world's largest economy and it's vast and there's considerable amounts of industries and manufacturing, a lot of manufacturing is no longer here. So that's why we have global supply chains and so much is imported from our, our partner countries like Canada, Mexico, and Asia, Europe, Latin America, Africa, and elsewhere is over time, they're because of international trade um, and comparative and absolute advantages countries have for many different reasons. We have the global trading system we do. So it's not that easily to flip a switch in a month and say, oh, let's source all of this in the US because it doesn't happen overnight. So
Yeah.
the impact is real. It's going to have an impact. The extent of the impact will is to be determined. Um, but I think most companies will see that there will be some level of impact, and they will have to look at alternatives or pay
Yeah.
higher prices. At the end of the day, they can keep doing what they do, but they'll probably have to pay more.
Yeah. One other thought I wanted to kind of chime in, Mark, is just on the economic outlook. As we've been looking at the GDP growth in the US, over the past 50 years. Like historically, it's been around the 3% range. Um, the next
Yeah.
2 years, we're seeing a little bit of like a slight dip in that growth expectation in the U.S. And so, one of the things as a business owner and for the CPG companies out there um, that are part of the Well Network, and that we're also helping to advise, is next year and even the year after, it will likely be like a tougher economic environment, and so you know to be prepared for that. Obviously we're hoping for the best but preparing for the worst, and it's something that that for if you're an owner, you're a founder, you're part of a growing company, is just to have that mindset of a tougher, potentially tougher economic environment, for next year. So I think that's just important kind of note there and caveat as we're looking at these growth rates.
In fact, that's a nice segue into the last outlook that I'll share, which is the investment climate. So at the Well, we've really been fortunate to have, founders of a variety of companies in the CPG, consumer tech, and wellness sectors. And we also have a number of investor members and partners from, and investment is sort of the lifeblood to really support this industry. And that climate certainly is also very challenging and certainly not what it was, say, back in the heyday of 2021, um, when low interest rates were very low. So I can dive into this part and then, turn it over to you, Brian, for some other outlook um, areas we want to cover. So, interest rates are coming down again slowly, but certainly we're not going to see the boom in investment again, which has been declining like 35% from 2022 to another 15% in 2023. Um, Overall, across the board, there's been less investment for the 50,000 or so seed and early stage founders. As investment has sort of been a lot more cautious than before. Um, though there are some slight increases, like for early stage funding, late 2024, according to Crunchbase, that increased about 10%. Although most of this money, no surprise, has been going to the hottest uh, types of sectors and companies like AI, IT, enterprise software. That represents about almost a third of investments. And, right after that is healthcare and med tech at about 28%. Consumer goods and services make up about 10%. So, 10% of the pie or so. Um, in addition to founders of different stages of growth, venture firms are also facing a lot of difficulty in raising funds or raising, follow-on funds. Um, that's represented a huge 62% decline in 2023 and less investors out there from about 15,000 to 11,000 in 2024, who call themselves venture investors of different types. However, global venture capital has ticked up slightly at the end of this year at about 94 billion. Again, a lot of that growth and focus has been on AI in addition to clean tech, according to Bain Capital, um, or Bain Consulting. Outlook for 2025 is unpredictable, though could improve if the interest rate environment goes lower. Goldman Sachs is predicting about a 3.5% average interest rate environment next year. The incoming Trump administration is proposing to reduce a lot of regulation, so that could impact a number of sectors. It also is proposing to cut taxes. Um, so there could be more M&A activity out there in the investment world. Um, let's look at the next slide. So, oh, wait, did I skip
Maybe,
one?
yeah, maybe we
Okay,
can go there. Like one thing I just wanted to add here is, we see a lot of early stage businesses within the well, and also within the Food Institute, and it's like Mark said, it is a very tough environment. What VCs and even seed at this stage, angel investors, they want to see a clear path to financial sustainability. We're no longer, as we all know, we're no longer in the days like 5 years ago, 6 years ago, where VCs were willing to accept multiple years of negative cash flow. Um, Now it's completely changed. Like they want to see at least a clear path to sustainability in 12 months, basically within 12 months or around that time frame. And also, ideally, they want to see financial like cash flow positive businesses, right? So it's a tough funding environment. And yeah, I just wanted that to be like something that for our members that are founders and in is to prepare for that. And there might be some opportunities, especially where you can get capital from family and friends, and that are willing to put in, whether it's 50, $100,000 checks without kind of the financial demands that VCs typically would put on founding companies. That's an option. There are some other alternative lenders out there that despite a higher interest rate, it that might be another alternative, as well. And so it really depends on the stage and the type of company that you're building and you're growing. And yeah, it continues to be tough out there. So just wanted to kind of share a few thoughts.
sure. I believe the next section is yours, Brian. Um,
Yeah.
and and agree to kind of wrap up that thought is, it's being nimble, adaptable, um, and flexible, and being creative at the types of financing, the types of partnerships, the types of communities, and that's one reason why we built the Well and have created these programs. Over the past year is to build those communities to support promising founders and to, build that trust among founders and those who can support, whether it be investors or retailers, advisors, and other partners. And so through our programs, we have brought a number of investors, venture firms, family offices, as well as others who can build that trust with founders, then they can sort of enable them as they move forward in you know, in their growth cycles. So we definitely will continue to do that moving ahead into next year. So Brian, turning to you for the trends on consumer.
Yeah, so I'll keep this pretty quick. So I'm going to be talking about some high level points on the state of the consumer and also some thoughts on AI and technology. I'll put a link of the report that the Food Institute recently did with Mondelez earlier this year on consumer trends, specifically around snacking. Um, so I just put it in the chat, Mark. I don't know if you could kind of share that with the rest of the attendees. That's a report directly from the Mondelez website, but just very high level. Food Institute worked with Mondelez to look at 25 trends that are impacting the food and specifically the snacking industry. We categorize these trends amongst kind of demographic changes, kind of lifestyle changes, kind of ESG type of changes, health and wellness, and more like the resurgence of the experience economy. So I won't go through these in detail, but I just wanted to share some high level points on what we're seeing with the consumer. Um, if you can go back there, yeah. So one of the things that Mark mentioned is that inflation is coming down, which is great. So thank God we're no longer above the 10% inflation rate on food. That's has come down to the 2 to 3%. Both at the food at home and food away from home. But one of the things that we constantly see in the data is that the wage growth has not kept in pace with inflation and specifically food inflation. And so the consumer is still strained. So a lot of the behavior, eating patterns, purchasing patterns, they're driven by what's in their wallet, right? And so what this is doing is it's driving consumers to private label food, right? So, the brands at Trader Joe's, for example, Aldi, Lidl, more and more foot traffic is being seen in those discount retailers. And right now, private label is represents about 20% of the market in food and beverage. That's expected to go to 25 to 30% over the next 5 years. And largely that's driven, by consumer, their ability to what's in their wallet basically. So the other thing that we're seeing is that, due to inflation, we've seen this during the pandemic, more and more people are eating at home um, to save on costs versus going out to restaurants, which is represented by the food away from home. That's something that's really that will likely continue to see in 2025 and 2026. What's really interesting is that, and this is from our webinar that we did yesterday with the folks at Circana and with Menu Matters yesterday. Um, we're seeing there's despite a lot of people going into the discount side or the value side of the food and beverage spectrum, we're also seeing more and more demand for premium and even premium. And so my third bullet point there is that the middle is getting squeezed, right? So either you have a large segment of the consumer population, they're going to more private label, they're going to more discount, but at the same time, there's also this interest in premium, super premium products, and they're willing to spend more on those types of products. And this is something that I think we'll continue to see. One of the companies that's part of actually I'll represent. There's two companies that we're working with right now at the Food Institute. One is a premium, is a premium kind of snack company. It's right now they're in Canada, but they're going to be moving into the U.S. shortly. They just got their product and featured at Erewhon, which is kind of like a super premium type of retailer out in the West Coast. Their price point for like a cracker, like a super healthy, functional cracker, they're retailing at $12 a box or a bag, compared to what would typically be in the market at the $7 to $8 range. And they're seeing velocity grow. Obviously, it really depends on where consumers are located. But it just highlights the fact that this premium and super premium product is still in demand, despite some of the effects of food inflation impacting consumers' wallets. Um, Another point on health and wellness, you know, it continues to evolve, right? So plant-based, as we know, has kind of seen has been, stagnant. I think there's a lot of concerns around some of the ultra-processed plant-based. I think there's more of a drive towards kind of clean label, fewer ingredients. Um, there's more products that consumers want around the emotional and the mental side. So Anxiety, loneliness has been a huge, these are big issues that, the U.S. consumers is facing on a day-to-day, week-to-week basis. Um, and so there, more and more, there's more and more of a demand for products that help with those mental, emotional types of needs that consumers want, right? And so, and that also includes like functional foods as well. So there was one example that one of the presenters yesterday in our webinar, she was saying that her son no longer buys vitamins. Because the son is looking for those types of same nutrients in a beverage format. So they don't need to consume two or three different products to get the nutrients and what they would want to put in their body. They want to get it from one place. So convenience and hyper personalization, these are things that will likely continue in 2025. Um, um, fourth, you know, Fourth point, big CPG brands, they're struggling right now. So, whether it's the Nestle's of the world, Kraft, Heinz, General Mills, um, and this is providing an opportunity for challenger brands, which is more like the up and coming growth type of businesses, um, to really take share from the big CPG guys. So, we've seen a lot of big name CEOs either be fired or there have been changes, management changes. Um, it's a lot of it is due to that the sales velocity of branded CPG it's slowing, and I think it's an opportunity for challenger brands to that have a great following that connect with consumers in new ways, and maybe that's through social media. These types of brands are resonating. We just featured one brand at the Food Institute called Luisa, which is a Hispanic brand that was founded and grown in Manhattan, and their whole goal is to make a more authentic version that can eventually be go mainstream. They're seeing a lot of success with their brands. So that's just one example. The last thing I'll say is that from a global flavors perspective, we're continuing to see more and more demand for novel. I'll put novel in quotes there, um, but new types of food experiences. And so Asian food has been on the rise for a couple of years now. We've seen Korean food, especially with whether it's kimchi powder, kimchi flakes. These are things that are being introduced to the market in non-traditional formats. When I was at CL Paris, I saw a new brand called Kelly Loves. They make a cleaner version of some of the Korean street food and flavors, and they're introducing that to the French market, and it's resonating, right? And so, but we'll continue to see the kind of this Asian influence become more and more mainstream. The Hispanic type of flavors, with with Pepsi's acquisition of Siete, as one example, that's already become mainstream. One of our most popular videos at the Food Institute, if you go to our YouTube channel, is it's a spotlight on how Mexican food is becoming America's cuisine. And so, that's it's we'll continue to see these global flavors come to shelves at retail, but also in food service as well. Last thing I'll say is as it relates to ESG, so this is environmental social governance. That was all the craze right after COVID. With the incoming president-elect Trump, we've seen somewhat of a pullback from kind of the ESG type of goals. But one thing I'll say is that ESG continues to be at the forefront, especially amongst the younger demographic. So Gen Z, and even millennials as well. This is not going away. And so consumers want to know that what they're putting in their body continues to help them from a physical and mental perspective, but they also want to have the psychological comfort that what they're consuming is also good for the environment and good for some of the social goals as that's basically defined by the United Nations Sustainable Development Goals. Uh, so that you can find that in that report. Happy to answer any questions there. If we can move on to the next slide, Mark. So yeah, that's just another, it's the same chart, but written in more detail. We'll definitely send that out, this presentation out once the webinar is over. Next slide, Mark. Yeah, so one of the things I just wanted to touch upon in terms of AI and tech adoption, um, when AI really kind of burst out into the scene, this was back in November of 2022, with ChatGPT. This, no one could have expected this technology to to basically scale so rapidly. And it seems like, every week we're seeing a new type of AI company. OpenAI, they just got their latest funding round at $157 billion. And this was announced, a couple of weeks ago. Anthropic also, another generative AI competitor, their valuation is at $40 billion. And basically over the past 2 years, there's been those that have had great success in utilizing AI, and the majority that really have not. And this is a study that I thought was pretty interesting to highlight by Boston Consulting Group, and they did a survey of a large sample of companies, and what they found is that the majority of businesses, so about 74% of businesses that they surveyed, they are sort of like characterized as stagnating in their adoption and utilization of AI. And only about 26% are finding a positive ROI. Why is this important? As Mark mentioned in his funding page, cost of capital has gone extremely high, right? Not just for capital, but even cost structures of businesses, from employee costs. It's continuing to rise on a year-to-year basis. AI is one of the few ways to help minimize the impact of these higher cost structures. And what I found is as I'm dealing with companies and even our audience, which represents a broad selection of manufacturers, food service, retail clients, but also across from the early stage startups to Fortune 500, the majority are still trying to learn how to use AI to help their businesses grow. Um, and this is one of the few ways that of to helping companies become more efficient and more optimized in 2025. We're going to see that separation between the haves and the have-nots even greater in 2025. Um, and one of the things that we're discussing internally amongst the founding team here at the Well is actually doing an AI masterclass to help train different professionals in food and beverage to know how to use AI based to on different types of functions within the business, whether it's marketing, whether it's content, communications, what have you. So at the current stage of where AI is at, if companies are able to utilize it and get a positive ROI, it potentially can increase margins and even growth anywhere from 10 to 30%, which the numbers are quite staggering, right? So, but only a handful of businesses are actually are able to realize those benefits. And so I just wanted to kind of mention that because I do think that this is an opportunity for early stage businesses to know how to use AI to help amplify and grow their business, from the sales and especially on the marketing side. Um, Last thing I'll say, there's also downsides of AI. Um, as I've been talking to different companies and helping train companies on AI, there's growing skepticism on the output of AI. Um, a lot of the posts you probably seen it on social media, whether it's on LinkedIn or Facebook. When I read a post, I know if it was written by AI or if it was written by an actual human. And so um, a lot of times when I read a post and I know that it was written by AI, I lose. Personally, I lose respect and trust for the person actually making the post because I know that those thoughts were not from him. It was just a copy and paste from ChatGPT. So you know, I think there's certain ways to use AI very effectively. When it comes to business development and relationship building, I'd be very careful about relying too much on AI to come up with different types of content, right? So you want to make sure that AI is used in a way that doesn't take away from the authenticity of a person's own voice, but also the what the company wants to convey. So I'll pause there, Mark. Maybe you have some thoughts on AI and tech adoption. Anything you'd like to add, either on this page or on the consumer evolution page.
Yeah, no, I really appreciate your perspectives, Brian, both on the consumer side as well as AI tech adoption. Um, and yes, it's like I agree with your analysis of where the consumer's headed, what's important to them, and what's meaningful. Um, and again, with AI, definitely agree that there's still very much a human dimension to putting out your voice as part of, whether it's marketing or messaging or communications of any sort, that it's still very important um, to be authentic in that voice. And that's why, with the well, we try to, we certainly have members who are in this space, in the AI consumer tech space. Uh, but we also try to bring people together to share best practices of whether you're utilizing these tools for sales, marketing, uh, operations, finance, or however it may be, to be efficient, but to at the end of the day, the humans and the founders and their team have to make the decisions that are best suited for their product, service, or growth. So I do notice we are a little bit over our scheduled time, but we certainly want to kind of highlight some closing thoughts and take any questions because we still have a little bit more time for to wrap up. So I guess you already cited these statistics
Yeah,
for the
yeah.
most part.
Basically, this page that highlights some of the areas where companies are finding success in AI and AI adoption. We'll send these slides out to everyone. And if you have any questions, feel free to reach out to me. But yeah, Mark, you can go on to the next slide.
Great. And some closing thoughts before we take any questions is we do have some upcoming programs. Next week, our colleague Matt Prylutsky of Roadmap Advisors is going to talk about M&A preparations. So his specialty is sort of later stage companies and companies preparing for exit. But even though companies may not be at that stage, earlier or middle stage in their growth, it's good to be ready with that M&A preparation in mind. So that'll be same time next Wednesday at noon Eastern. So you're all welcome to tune in. And then January 15th, one of our members, marketing uh, a specialist, Robin Young, will have a webinar on the brand curve. which she's conveyed her expertise in that area to quite a number of audiences. So we're excited to have her share them. We do have New York and LA programs being planned for early next year, including February, that we'll announce soon. We also have March 4th, 2025, at the same location where we launched The Well this year. So you can see that's the photo of our event, which was a panel focused on women innovators, where we had about 250 industry guests and 8 panelists. So we'll have a related event focused on spotlighting women in CPG and other programming at the same location, which is in Southern California, close to the Anaheim Convention Center at the Bowers Museum. Our members and partners are also planning in-person programming in Boston, DC, and Chicago for the spring of 2025. So a lots more in-person programming ahead. Um, and we do welcome you to join as a partner member. This is actually our recent program at the D'Angelico Guitar Showroom on November 21st in New York City, where we featured a panel on e-commerce with our partners at Witham. So feel free to reach out to us at the Well, myself and Brian. Follow our updates on LinkedIn or Instagram. And if you'd like to join our community or partner with us, we definitely welcome that. And that's how we've grown organically since last March. So we're excited for the year ahead and welcome any questions or comments. And thanks again for joining us today.